Most traders think breakouts are obvious. They believe the move begins when the chart finally looks clean, when price pushes past resistance with volume, when everyone can see it. But by the time it looks obvious, the opportunity has already begun to slip away. Let me ask you something. If everyone can see the breakout, who is left to push price higher? That's the first crack in the illusion. Because markets don't reward recognition, they reward anticipation. If you watch price closely, really watch it, not just glance at patterns, you'll notice something subtle. Before a breakout becomes visible, behavior changes. Price starts to compress. Volatility tightens. Reactions become smaller, but more deliberate. Have you ever seen a market that just stops reacting the way it used to? That's not random. That's pressure building. You see, breakouts are not events. They are processes. And most traders only notice the final stage, the expansion, while ignoring the quiet accumulation that comes before it. Think about it like this. If price repeatedly tests a level and refuses to drop significantly, what does that tell you? It tells you sellers are losing control. Not suddenly, but gradually, quietly. And here's the part most traders miss: strength doesn't always look strong. Sometimes it looks like boredom. Does that sound counterintuitive? It should, because the crowd is trained to chase excitement. Big candles, fast moves, noise. But the real move often begins in silence, when price barely moves at all. Now let's go deeper. When a market compresses, it's not just price tightening. It's a shift in supply and demand. Orders are being absorbed, positions are being built, and importantly, weak hands are being shaken out. Why does that matter? Because a breakout without preparation is fragile. But a breakout built on absorbed supply, that's something entirely different. Have you ever entered a breakout that immediately failed? Of course you have. Everyone has. And if you look back honestly, you'll notice something. There was no real build-up. No pressure. Just a sudden move that looked convincing, but lacked foundation. So the question becomes, how do you spot the build-up before the move? Start by observing behavior, not patterns. Look at how price reacts to key levels. Are pullbacks getting weaker? Are buyers stepping in earlier each time? Is volatility shrinking? These are not signals you'll find in indicators. They're clues hidden in plain sight. But here's where discipline comes in. Can you sit and watch a market do nothing without forcing a trade? Because most traders can't. They confuse activity with opportunity. They feel the need to act, to participate, to be involved. And that impatience blinds them to the very setups they're looking for. Let's make this practical. Imagine price approaching resistance. The first test rejects sharply. The second test pulls back less. The third barely pulls back at all. What's happening here? Supply is being absorbed. Now ask yourself, if sellers were still in control, would price behave this way? No, it would reject strongly each time. So by the time price is pressing tightly against resistance, something has already changed. The breakout isn't a surprise, it's a consequence. But here's the trap. Most traders wait for confirmation. They want the breakout candle, the volume spike, the clear signal. And again, I'll ask you, if you wait for confirmation, what are you really doing? You're paying a premium. You're entering when risk is highest and edge is lowest. That doesn't mean you should blindly anticipate every breakout. That would be reckless. The goal is not to predict, it's to recognize when probability shifts. And probability shifts during the build-up, not the breakout. So how do you position yourself? You start thinking in terms of scenarios, not signals. You observe compression and ask, if this continues, what is likely to happen? Then you plan your response before the breakout occurs, not after. Because once price breaks out, emotions rise. Decisions become reactive, and that's when mistakes happen. Have you noticed how clarity disappears the moment the market speeds up? That's not coincidence. That's pressure. Now consider risk. Entering early, during the build-up, often means tighter stops and better positioning. Entering late, after the breakout, means wider stops and more uncertainty. So the real question is this: do you want to trade where risk is controlled or where excitement is highest? Most people choose excitement, and they pay for it. There's also a psychological layer here that you can't ignore. Catching breakouts early requires patience, but also discomfort. You won't have confirmation. You won't have certainty. You'll have to act on observation and reasoning. Can you trust your read of the market without needing validation from the crowd? Because if you can't, you'll always be late, and being late in trading is expensive. Let's talk about what to avoid. Avoid chasing large breakout candles. Avoid entering when price is extended away from structure. Avoid trades where the move already feels obvious. Why? Because by then, the imbalance has already been exploited. You're not catching the move, you're following it, and followers rarely get the best price. Instead, train your eye to notice subtle shifts. Watch how price behaves at the same level over time. Watch how reactions change. Watch how quickly, or slowly, price moves away from key areas. These small details tell a bigger story, but only if you're paying attention. Now here's something worth thinking about. What if the breakout you're waiting for has already started? Not in price, but in behavior. Because price is just the final expression of something that began earlier. And if you can learn to read that earlier stage, you won't need to chase the move. You'll already be there. So next time you're watching a chart, don't ask, has it broken out yet? Ask, is it preparing to? And then ask yourself something even more important. If it does break, will I be reacting, or will I already be positioned? Compression is quiet strength, not market indecision. Most traders see a market slowing down and assume nothing is happening. Price stops making large moves, candles shrink, and everything begins to feel stagnant. Naturally, they lose interest. They step away, or worse, they force trades out of boredom. But let me ask you, if nothing is happening, why isn't price falling? That's the detail most people overlook. Because a market that truly lacks interest doesn't hold its ground. It drifts, it fades, it loses structure. But when price compresses tightly near a level, especially near resistance, it's not drifting, it's holding, and holding requires effort. Compression is not inactivity, it's controlled pressure. Think about what has to happen for price to stay confined within a tight range. Every time sellers try to push it down, buyers step in. Every time it edges higher, doesn't collapse, it stabilizes. That balance isn't neutral. It's a sign that something is being absorbed. Now ask yourself, who is doing the absorbing? Because it's not the crowd. The crowd reacts to movement. It doesn't quietly build positions in tight ranges. What you're seeing during compression is often larger participants operating without urgency, accumulating or distributing without revealing their full intent. And here's where it becomes interesting. The longer price compresses without breaking down, the more pressure builds. Not visibly but structurally. Orders stack. Liquidity gathers. Weak traders get shaken out by small moves, while stronger hands remain. Have you noticed how false breakouts often happen during these phases? Price pokes above or below the range, triggers entries, then snaps back. That's not randomness. That's a clearing process. It removes impatience. It resets positioning. So by the time a real move happens, the path is cleaner. Now consider how most traders interpret this phase. They see choppiness. They see uncertainty. They label it as no trade zone. But what if this is actually where the trade begins? Because once price leaves compression, the move is already underway. The expansion is just the visible part. The real work, the positioning, the imbalance, was built earlier. So if you only act during expansion, you're always late to the structure that created it. This doesn't mean you blindly trade every tight range. That would be careless. The key is context. Where is the compression happening? If it forms near a significant level, especially after a directional move, it carries meaning. It suggests continuation pressure. It suggests that the opposing side is struggling to regain control. Now think about behavior again. Are pullbacks getting smaller? Are reactions weaker? Is price spending more time near the highs than the lows? These are not random details. They are signs of control. And control in markets rarely announces itself loudly. It shows up quietly in the form of stability where instability should exist. So instead of asking, why is the market not moving? Start asking, why is it holding here? Because that question shifts your focus from surface level movement to underlying intent. And once you begin to see compression not as hesitation, but as preparation, your entire approach changes. You stop chasing movement and start studying behavior. You stop reacting to what already happened and start anticipating what is building. But that requires patience. Can you sit through a tight, slow market without losing focus? Can you observe without interfering? Because compression tests discipline more than anything else. It tempts you to act when you shouldn't and ignore when you should pay attention. And most fail that test. They leave just before the move begins, or they enter only after it becomes obvious. And that small difference in timing changes everything. Repeated level tests reveal weakening opposition, not randomness. Most traders see price hitting the same level over and over and think the market is confused. They call it indecision. They assume buyers and sellers are evenly matched, canceling each other out. But let me ask you, if a level keeps getting tested, what does that really mean? Because in any other environment, repeated pressure eventually leads to failure. A door doesn't stay closed forever if it's pushed again and again. At some point, the structure behind it starts to give. Markets behave the same way. Each time price approaches a level, orders are being executed. Sellers at resistance are stepping in, yes, but they're also getting filled. Their supply is being used up, quietly, gradually, without any dramatic signal. Now think about the alternative. If sellers were truly strong, would price keep coming back so easily? No. It would be pushed away decisively. You'd see sharp rejections, deeper pullbacks, hesitation before the next attempt. Strength defends aggressively. It doesn't allow repeated access. So when price keeps returning to the same level with less resistance each time, something is changing. Have you noticed how the pullbacks often become smaller with each test? That's not coincidence. That's information. It tells you that buyers are becoming more confident, stepping in earlier, willing to accept higher prices. At the same time, sellers are losing their ability to push price lower. Their impact weakens, even if the level still holds temporarily. This is where most traders misread the situation. They focus on the fact that the level hasn't broken yet. They treat it as proof that the level is strong. But strength is not defined by holding once or twice. It's defined by how price reacts around it. A level that barely holds is not strong. It's under pressure, and pressure changes outcomes. Now consider the psychology behind it. Every time price fails to break through, some traders lose confidence. They start shorting the level, expecting another rejection. Others place stop orders just beyond it, anticipating a breakout. What does that create? Liquidity. And liquidity is exactly what larger participants need. So while the crowd is focused on the visible level, the real game is happening in how price interacts with it over time. Orders are being absorbed. Positions are being built. The market is preparing for movement, even if it hasn't happened yet. Let me ask you something else. How many times have you seen a level hold multiple times, only to break suddenly and move quickly? That sudden move wasn't sudden at all. It was the result of repeated testing. Each test weakened the opposing side until there was nothing left to defend the level effectively. And when that final push came, there was no resistance strong enough to stop it. That's why breakouts after multiple tests tend to be more decisive, because the work has already been done. But here's the trap. Most traders get caught in the middle of these tests. They buy the bounce, then sell the rejection, then repeat, getting chopped up as the range tightens. Why? Because they're reacting to each individual move instead of understanding the broader process. They treat each test as a separate event, when in reality, it's part of a sequence that leads somewhere. So instead of asking, will it hold this time? Ask a better question. What has changed since the last test? Is the reaction weaker? Is the pullback smaller? Is price spending more time near the level? These are the details that matter, because markets don't break levels randomly. They break them when the opposing force is no longer strong enough to defend, and repeated tests are how that strength gets eroded. Not instantly, not dramatically. Obvious breakouts attract late money, not smart positioning. Most traders are drawn to clarity. They wait for the chart to look clean, for price to break a level with strength, for volume to expand, for everything to line up in a way that feels undeniable. It feels safe that way. But let me ask you, if it feels safe to everyone at the same time, what does that usually mean? Because markets don't offer comfort at the point of opportunity. They offer it at the point of participation, when the move is already visible, already convincing, already accepted. And that's exactly when late money enters. Think about what happens during an obvious breakout. Price pushes through a well-defined level, candles expand, momentum builds. Traders who were waiting for confirmation finally act. They buy the breakout, convinced they're catching the move early. But are they? Or are they stepping in after the imbalance has already shifted? Because by the time a breakout becomes obvious, the early positioning is already done. The build-up has already taken place. The orders that created the move have already been executed. What you're seeing is not the beginning, it's the release. And when everyone reacts to that release at once, it creates a surge of participation that often comes at a cost. Have you ever entered a breakout that looked perfect, only to see price stall or even reverse? That's not bad luck. That's positioning. Late entries tend to cluster around the same area. Stops sit just below or above the breakout point. Liquidity builds quickly. And once that liquidity is sufficient, the market doesn't need to continue immediately. It can pause, retrace, or even trap those who entered too late. This is where the misunderstanding runs deep. Most traders believe confirmation reduces risk, but in reality it often shifts risk to a worse price. You're no longer entering where the idea begins. You're entering where the idea becomes popular. And popularity in markets is rarely a good entry point. Now think about the psychology behind it. Why do traders wait for obvious breakouts? Because they want certainty. They want proof. They want to avoid being wrong. But here's the trade-off. Certainty comes at the cost of opportunity. The earlier stages of a breakout feel uncertain because they are. Price is still building. The move hasn't revealed itself yet. But that's also where the best positioning exists. So the question becomes, are you willing to act before the market proves you right? Because if you're not, you'll always be reacting to what already happened. And reaction is slower than anticipation. That doesn't mean every breakout should be faded or avoided. Some breakouts continue strongly even after becoming obvious. But the key difference is understanding where you are in the move. Are you early in the process, or are you joining the crowd? Because those are two very different trades. One is built on observation and preparation. The other is built on reaction and emotion. Now consider this. When price breaks out and accelerates, who is providing the liquidity for early participants to exit or scale out? It's the late money. The traders who waited, who needed confirmation, who entered when the move looked clean. They are often the ones filling the orders of those who positioned earlier. And that dynamic is not accidental. It's how markets function. So instead of asking, is this breakout strong? Ask something more useful. Who is entering here? And who might be exiting? Because that question shifts your focus from the surface to the structure. It forces you to think beyond the candle in front of you and consider the positioning behind it. And once you start thinking that way, obvious breakouts begin to look different. They stop looking like opportunities and start looking like reactions. The best entries feel early, not comfortable. Most traders are taught to wait until everything lines up. Clean breakout, strong momentum, confirmation from indicators, something that tells them the trade is safe. And when it finally feels safe, they act with confidence. But let me ask you, why does it feel safe only after the move has already begun? Because comfort in trading is usually a reaction to visibility. When price has already moved, the direction becomes obvious. The story makes sense. The risk feels justified. But that sense of comfort comes at a cost. You're no longer early. Think about the nature of good positioning. It happens before the crowd agrees, before the chart looks perfect, before the move becomes obvious. And that timing creates a certain discomfort. You don't have full confirmation. You don't have momentum yet. You have observation, context, and a developing idea, and that doesn't feel safe. Have you ever hesitated on a setup that made sense, only to watch it move without you? That hesitation wasn't about the setup. It was about the lack of comfort. Because entering early means accepting uncertainty. It means acting before the outcome is visible. And most traders are conditioned to avoid that. But here's the contradiction. Uncertainty is where the edge exists. By the time certainty appears, the opportunity has already shifted. Now consider what early entries actually look like. They often happen during compression, near key levels, when price is holding rather than moving, when behavior is changing but not yet obvious. There's no excitement, no large candles, no sense of urgency, and that's exactly why most people ignore them. Because they don't feel like opportunities. They feel like nothing. But let's look deeper. If price is compressing near resistance, holding its ground, refusing to pull back, what does that suggest? It suggests pressure building. So entering during that phase is not guessing. It's positioning based on behavior. It's recognizing that something is developing before it becomes visible. Now compare that to entering after the breakout. Price has already expanded. Momentum is clear. Everyone sees it. But what has changed? Risk has increased. Distance from structure has widened. Stops become less precise. And most importantly, the move is no longer in its early phase. So while the trade feels more comfortable, it's actually less efficient. Have you noticed how trades that feel easy often don't perform as expected? That's not coincidence. It's because ease often comes from alignment with the crowd. And when too many people are aligned, the market doesn't need to continue in the same direction immediately. Comfort attracts participation. Participation creates imbalance. And that imbalance can lead to instability. Now think about your own decision-making. When you wait for confirmation, what are you really waiting for? You're waiting for the market to prove you right before you act. But trading doesn't reward proof. It rewards preparation. So the goal is not to eliminate uncertainty. It's to understand it. To recognize when uncertainty is part of a developing opportunity, rather than a reason to avoid it. That shift changes everything. Instead of asking, is this confirmed? You start asking, is this building? And that question leads you to different entries. Entries that feel less comfortable, but are closer to the source of the move. Now this doesn't mean acting without discipline. Early entries still require structure. They still require a clear idea of where you're wrong. But they don't require the market to look perfect. In fact, if it looks perfect, you're probably late. So the next time you see a setup forming, tight price action, repeated tests, subtle strength, pay attention to how it feels. If it feels slightly uncomfortable, slightly uncertain, slightly early, you might be looking at something real. Price holding near resistance signals absorption, not hesitation. Most traders see price stall near resistance and assume the market is struggling to break through. They interpret the pause as weakness, as if buyers are running out of strength just before the level. But let me ask you, if buyers were truly weak, why isn't price pulling back? Because weakness doesn't hold position. It gives ground. When price reaches resistance and stays there, hovering, pressing, refusing to drop, it's not hesitating, it's engaging. There's a difference. Hesitation looks like rejection. Absorption looks like persistence. And persistence changes the story. Think about what's happening beneath the surface. Every time price touches resistance, sellers step in. They place orders, expecting the level to hold, and for a moment it does. But then something subtle happens. Price doesn't fall away. It doesn't retreat with force. Instead, it lingers. It absorbs the selling pressure, trade by trade, without giving sellers the follow-through they expect. Now ask yourself, if selling pressure was strong, wouldn't price move lower quickly? Of course it would. So when that doesn't happen, it tells you something important. The selling is being met, matched, and gradually consumed. This is absorption. It doesn't look dramatic. There's no explosive move. Just a quiet refusal to go down, and that quiet behavior is often misunderstood. Have you noticed how price sometimes forms tight ranges just below resistance? Small candles, limited movement, repeated attempts to push higher, followed by shallow pullbacks. That's not indecision. That's pressure building, because every small pullback that fails to gain momentum is a sign that sellers are losing control. They can slow price down, but they can't push it away. And over time, that imbalance grows. Now consider how most traders react to this. They see resistance holding and assume it's a good place to short. After all, the level has worked before. It feels logical to expect the same outcome, but markets don't reward repeated assumptions. They evolve, and a level that has been tested multiple times, especially with price holding tightly beneath it, is not as strong as it appears. In fact, it's often at its weakest just before it breaks. Let me ask you something. How many times can a level absorb pressure before it gives way? Because each test is not just a test, it's a transaction. Orders are being filled. Liquidity is being consumed. So by the time price is sitting right under resistance, barely pulling back, the question is no longer, will it hold? The better question is, how much supply is left? Now think about the behavior again. Are the pullbacks shallow? Are buyers stepping in quickly after small dips? Is price spending more time near the highs than the lows? These are signs of control. Not aggressive control, but steady, persistent control. And that kind of control doesn't need to announce itself loudly. It just needs to remain. This is where patience becomes critical. Because absorption takes time. It doesn't happen in one move. It unfolds gradually through repeated interaction with the level. And during that time, the market can look slow, even frustrating. Have you ever left a chart because nothing was happening, only to return and see a breakout already in progress? That nothing was the process. You just didn't recognize it. Now here's the key distinction. If price hits resistance and immediately pulls back sharply, that's rejection. Sellers are still in control. But if price hits resistance and stays there, tight, stable, persistent, that's absorption. And absorption changes probability. It doesn't guarantee a breakout. Nothing does. But it shifts the balance. It tells you that the opposing force is weakening, even if the level hasn't broken yet. So instead of focusing on whether resistance is holding, focus on how price behaves while it's there. Because behavior reveals intent, and intent shows up before outcome. But only if you're willing to see it before it becomes obvious. Volatility contraction often precedes directional expansion. Most traders pay attention when the market is moving. Large candles, fast swings, sudden momentum, that's what captures attention. That's when it feels like something is happening. But let me ask you, what happens just before those moves begin? Because if you only focus on expansion, you're always reacting after the fact. Before markets move, they tend to quiet down. Price tightens, ranges shrink, movement becomes less dramatic, almost uneventful. And to most traders that phase feels uninteresting. They call it slow. They call it choppy. They assume there's no opportunity. But what if that quiet phase is exactly where the opportunity begins? Volatility contraction is not the absence of movement. It's the preparation for it. Think about it in simple terms. When price swings widely, there's already imbalance in the market. Buyers and sellers are pushing aggressively, creating movement. But when those swings start to shrink, something changes. The market begins to stabilize. Now ask yourself, why would a market that was moving aggressively suddenly slow down? Because opposing forces are starting to balance out, at least temporarily. Orders are being absorbed. Positions are being built. The market is transitioning from movement to structure, and structure is where pressure builds. Have you noticed how ranges often get tighter before a strong breakout? That tightening is not random. It reflects a reduction in volatility, but an increase in tension. It's like a spring being compressed. The more it compresses, the more energy is stored. And when that energy releases, the move tends to be sharp and directional. But here's where most traders misunderstand the process. They see contraction and assume nothing is happening. So they either overtrade within the range, getting chopped up, or they step away entirely. Both responses miss the point, because contraction is not meant to be traded aggressively. It's meant to be observed. This is where you study behavior. Is the range forming near a key level? Are the highs getting slightly higher? Are the lows holding steady? Is price spending more time on one side of the range? These subtle details tell you which side is gaining control even before the move begins. Now think about timing. If you wait for expansion to confirm direction, You're entering after the move has already started. That doesn't make it wrong, but it does change the risk. Entries become less precise. Stops become wider. The reward to risk shifts. So the advantage lies in recognizing contraction early and preparing for what comes next. Not predicting blindly, but understanding the conditions. Have you ever seen a market break out of a tight range and move quickly, almost effortlessly? That speed doesn't come from nowhere.